All right, welcome to Talk Tickers. We've got a really interesting one for you today. NerdWallet's latest earnings report. Now, on the surface, everything looked pretty rosy. They beat on profit, they even raised their guidance for the full year, but the market absolutely hammered the stock. So the big question is, what did Wall Street see that maybe management was hoping they wouldn't? Let's dig in and figure this out. So this right here, this is basically the whole story in a nutshell. You've got two completely different takes on the exact same quarter. On one side, you have management saying, hey, look at us. We're more profitable than ever, and we're raising our outlook. But then you have the market, which basically heard, nope, sell, you missed on revenue, and your guidance is weak. It's like they were listening to two different earnings calls. Just wild.
And yeah, the market did not mince words. The verdict came in fast and hard. We're talking a 17.1% drop the very next day. I mean, that's not just a little pullback. That is a full-blown investor revolt. A massive vote of no confidence. So we've got to ask why? Why such a brutal reaction? Let's peel this thing back.
Okay, to really get what's going on, we have to dive into the headline numbers. And this is where you can see how it really was a tale of two tapes. There was something for the bulls and definitely something for the bears.
So let's start with the bad stuff, the part that really spooked everybody. Revenue. It came in at about $187 million. Now, you might look at that and think, hey, that's up 24% from last year. What's the problem? And you're right, that's solid growth. But, and it's a big but, it missed what Wall Street was expecting. And for a company that's supposed to be all about growth, missing on that top-line number, that's always going to be a huge red flag for investors.
But here's where it gets complicated. While revenue was a letdown, the bottom line, the actual profit, was a whole different story. A great story, actually. NerdWallet posted $21 million in what they call non-GAAP operating income. You can just think of that as their core profit. And that number didn't just beat their own guidance, it absolutely smashed it. They were guiding for $18 million on the high end. So you can see, this was the number management was so proud of, the real bright spot in the report.
So you've got this split result, right? A revenue miss, but a profit beat. How does management explain that? Well, this gets us to their main story for the quarter. They basically weren't even apologizing for the revenue. Instead, they were trying to reframe the whole thing as a deliberate strategic choice, a pivot toward being a more efficient, more profitable company for the long haul.
And the CEO, Tim Chin, he said it pretty plainly. He's like, yeah, revenue was a little light. We had a temporary hiccup in our insurance business. But for him, the real story, the big takeaway, was that the company got way more efficient. They're running leaner, and that's what drove that awesome profit number. You know, it's that classic business story. Let's sacrifice a little bit of growth right now to build a more profitable company for the future.
And this chart really shows you what's going on under the hood. Just look at the revenue mix here. You can see insurance and what they call emerging verticals are just exploding with huge year-over-year growth. And that's on purpose. They're actively shifting away from their old bread and butter, like credit cards, which you can see is actually shrinking. Why? Because that area is getting hit hard by changes in how search engines work. So they're betting big on the new stuff, where they have more control and can make more money.
And a huge piece of this new strategy is a concept they kept talking about, vertical integration. It sounds complicated, but it's actually pretty simple. All it means is they want to own more of the process. So instead of just sending you to a mortgage lender and getting a small finder's fee, they've now bought their own mortgage brokerage. That way, they handle the whole deal themselves. It's a no-brainer, really. They get to keep a much bigger slice of the pie and build a stickier relationship with you, the customer.
Okay, so if profits were great and the new strategy sounds pretty smart, why on earth did the stock get absolutely demolished? Well, this brings us back to the market side of the story. And it really boils down to one simple, maybe brutal truth about investing in tech companies like this. A lot of the time, top-line growth is the only thing that matters.
I mean, just look at how this played out in real time. The stock's sitting pretty at over $11 a share. Then boom, the earnings report drops after hours, and by the end of the next trading day, it's down to $9 and change. That's just a brutal, immediate rejection of the story management was trying to sell. The market just wasn't buying it.
And here's the bottom line on why. Investors looked at the good and the bad, and they put all their weight on the bad. Look, a revenue miss is one thing, but guiding to just 1% growth for the next quarter, 1%, when you just grew 24%, that's not a slowdown, that's like hitting a brick wall. And for Wall Street, that terrifying forecast, plus the ongoing problems with search traffic, it just completely wiped out any good feelings about the profit beat. So, that's the play-by-play of what just happened. Now let's switch gears and look ahead. What does all this mean for the stock going forward?
What are we going to be watching for on the next earnings call? This is our take.
And really, it all boils down to this one critical question if you're looking at the stock right now. After a drop that big, is NerdWallet what we call a value trap? A stock that looks cheap for a reason, a bad reason? Or is this a real turnaround story in the making and the market is just missing the bigger picture?
Let's break down the two opposing camps. You've got the bulls, the optimists, who are going to point right to that raised profit forecast for the whole year. They'll say, hey, that insurance thing was a one-time blip, it's already fixed. But then you have the bears, the pessimists, and they're just going to keep hammering on that scary Q3 revenue guide and remind everyone that the problems with search traffic aren't just going to magically disappear. It's the ultimate showdown, solid profits today versus a scary growth outlook for tomorrow.
So with this intense tug-of-war playing out, we're landing on a market perform rating. Look, the company's doing a great job on the efficiency front, no doubt about it. But until they can show us, and the rest of Wall Street, a believable plan to get that top-line revenue growing again, we think the stock is probably stuck in neutral. The risk and the reward just feel pretty balanced right here.
Okay, so how could you actually trade this view? One idea that we think is pretty interesting is a pair trade. Here's how it works. You go long NerdWallet, you buy their stock, but at the same time, you short one of their competitors, specifically one that's completely reliant on that tricky organic search traffic. The whole point of this trade is to isolate your bet. You're essentially saying, I believe NerdWallet's vertical integration strategy will make them a winner relative to their peers, while at the same time, you're protecting yourself if the whole sector gets hit by those search headwinds.
So at the end of the day, the next earnings call is everything. It's basically a referendum on this whole strategy. Can management prove that this short-term pain in the growth numbers is actually going to lead to long-term gain? The market has clearly said, we don't believe you. Now the ball is in their court to prove everyone wrong. And just a quick reminder, of course, this is not financial advice. Make sure you do your own homework.